This is the part 4 of 4-part series. In part 1, I covered why is finance acumen important for non-financial managers. Regardless of where an individual is, be in a human resource function or operations or purchasing or sales, they may not be looking at financial data like the folks in finance and accounting group will do. But I think it is important for every manager to be familiar with some of the finance knowledge. So I covered that, overview of that in part 1. In part 2, I touched on connecting the strategic planning with the financial planning. In any company, enterprise, regardless of industry or size, there is strategic planning activity that takes place, with all the dynamics outside the company, with the change in the, economic factors, the industrial factors, the technology. Obviously it's important for a company to always be looking forward. So I touched on it briefly as far as how does one look at financial planning, and try to connect it with the strategic planning. In part 3, I touched on what are some of these steps one would go through if they're thinking of developing a financial plan for their business. So these are all approximately 30-minute modules. So I don't get too detailed, and because it is for finance or non-financial managers, I provide enough detail, especially from a holistic and strategic perspective, that's going to give you a pretty good feel. I'll do something similar today on the topic of financial ratios to analyze financial health of a company. So the learning outcomes for this module is that I'll start with an overview, what is financial ratios, why they're important, and as the financial ratios are there to assess how effective management team is in managing the company, it obviously is connected to the financial statements. So I'll share with you the connectivity of that. Because if you really think about it, every business strategy, the success of the strategy is measured by how effective are the financial results in the future. So the financial results are the byproduct or the output of the good strategy well executed. I'll share with you some of the ratios, and then, just to kind of see how one would apply it, I will take some of the ratios, maybe 3 or 4 of them, and we're going to look at 2 companies, TJ Maxx and Macy's. They're both obviously in the retail industry. So financial ratios, I describe them as a measurement gauges. This is, way to measure how well the company is doing. And because they are ratios, which means there is a numerator and a denominator, it helps us normalize it for the size. For example, Walmart in a retail industry is, as you all know, quite large. Their annual sales is over $500 billion. So that's like $500 billion. They're way bigger than Amazon. So if you want to compare, say, Walmart to another company that also has brick and mortar, like Macy's, you cannot compare them on an absolute basis. Walmart sales are $500 billion. Macy's sales are $25 billion. Even it's a big number, $25 billion, but it's 1/20th the size of Walmart. So it'd be hard to compare the profit value, the dollar value of Macy's or the inventory value of Macy's with Walmart. You have to somehow normalize it to make that comparison. So that's really the benefit for ratios. So it allows us for a meaningful comparison. For example, if you're looking in a company, within a company, let's say looking just at Macy's or just as Walmart or TJ Maxx, you can see over the last 5 years, how do they look like? And because they're normalized, even though the sales numbers may have changed, gone up or down, because you're normalizing it, you can make a comparison year by year, or you can make a comparison with a competitor, or see how they're doing within the industry. Now, it's important that when you're using the ratios to compare two companies or multiple companies, they all have to be in the same industry, in the sense that you cannot compare, say, Walmart or TJ Maxx or Macy's with a company like Ford Motor Company or General Motors or Toyota, because there will be apples and oranges. Because the industry has an effect. Obviously, auto industry has got a different industry effect in terms of, global economy, what is happening to the, the trade tariffs, etc. So that is slightly different than what you will see, in some of the other industries. So you want to compare companies within the same industry. Now, the financial ratios, the data obviously is coming from the reported data, which is the financial statements. And so it is important for us to do a quick, brief overview of what a balance sheet and income statement is, because that's where the data is coming from. I did cover, some of it in detail in Module 1, but because the ratios are all connected to these statements, it is really important that we kind of briefly cover it so you get a pretty good feel for it. So, starting at a holistic level, for all managers, leaders, regardless of what role they play in what industry, there are two common factors in every organization, and they are managing people and managing finances. So managing people, you want to have a great leadership strategy, human resource strategy, talent optimization strategy, mentoring program, etc., training. How you organize your structure, that is important, organization structure. All that is people managing strategies. And then you got the managing finances, how you manage your business, etc. And because you're managing finances, regardless of the company, be it as big as Apple or Ford Motor Company or any industry, local within Connecticut, corporation like United Technologies, or even within a large corporation like United Technologies, you got Otis, you got Carrier Air Conditioning, and you got UTC Aerospace. They will have income statement and balance sheet. Why? Because the management will have a leadership strategy, and where you measure the performance of a company is through income statement and balance sheet. Could be an insurance business like Travelers or Mass Mutual. So regardless of the size, there will be a balance sheet and there will be income statement in every company. And what ratios allow us to do is to kind of look to see how effectively is the business being managed by looking at some of the key parameters with balance sheet and income statement. So before we can get into those formulas and parameters, I will do a quick overview of a balance sheet and income statement. Okay, a balance sheet. Balance sheet has got three components. You got assets, which is what company owns. You got the liabilities, what the company owes, which means this is where the business has gone and borrowed money, so they can use it to put it in the business to buy assets or and any investment that is made by the shareholders, the owners, is called the equity. So those are the three pieces. And typically you'll hear that asset is equal to liability plus equity, which obviously makes sense. Or the other way to think about it is whatever is the equity in the company is going to be your total assets that you own. You subtract from what you owe to the bank or the bondholders, and what is left over is the equity. So example of assets could be, you have your machine and equipment. You could have buildings, office space that they own, not the rental piece. This is the ownership. So this is the, they own, maybe they may own buildings themselves, or farm tractors, or even in the retail stores, you got the inventory, you got the shoes, you got the, the clothing, etc. These are all assets that are purchased, by the company. So they own it. So the assets are there, not to just look pretty on the shelves, but are there to generate sales and profit, which means they have to be sold at a price where they can make profit. Or if they have a building, they want to make sure that that particular building is effectively utilized to be able to, at the top level of the company, some level of creation of sales and profit. So the goal is the effective management of the asset is obviously very, very critical by the management team. So if you are part of the management team or if you're the leader of the organization, you're obviously focused on, we have all these assets. If we're going to add more assets or we're going to subtract more assets, we got to kind of strategically think through, why do we have these assets? Because it's obviously tying up our cash. So the overall goal is to enhance the profitability as a percent of assets, which means that if you have an asset, building, etc., how much profit are you generating from your assets? So one of the ratios, and we'll get into more of them, is that you're looking at the return, which is the net income or net profit, and you're dividing by the total asset. Of all the money that we have tied up, that we own as a business, it is ours because we spend the money purchasing it, which is the denominator. How much net profit are we generating? Because do we have all these assets and we're generating very little net profit? That would not be, a good ROA. So we'll talk about ROA as an example between, say, Macy's and TJ Maxx. I'll show you some numbers. You'll see it later on. Now, to improve the ROA, obviously you focus on the numerator and denominator. Ideally, you want to do is to grow your profit or focus on assets. Sometimes you will see that some factories, they will, outsource, etc., so they can cut back on asset. Now, just reducing asset may not be a good strategy by itself. So it has to be thought strategically. And it is okay to add assets. For example, if the company is growing, they may want to add inventory, they may want to add some more buildings, etc. But the overall goal is that as you're adding more in the denominator, which is the assets, let's say you grow your assets by 20%. You want to grow your asset by 20%. You want to make sure that the numerator, which is the net profit or the net income, is growing at minimum at 20%. Or ideally, the numerator is growing at a much higher percent than 20% if your denominator, which is the total asset, is growing at 20%. Now, what is also important is to understand where the money comes from to buy these assets, be inventory or buildings or equipment. It comes from, initially, when we start a business, it's coming from either borrowing it from the lenders, which means we borrow the money and now we owe them, so it will become part of a liability in our balance sheet. Or we can have investors, shareholder, invest the money. In that case, they own it, so it will be part of the equity. Now, once the business is up and running and it's profitable, then the income statement or the profitability will generate profit, which can be put back in the business, so then we can go in and grow our business through our own internal profitability. Let's take the balance sheet and break it down just a little bit. Because we're going to use pieces of the categories from different statements in the ratios, I just want to briefly provide an overview of some of the nuances, just not a lot of detail, but enough that you get a feel for it. So assets can be broken down into current assets and long-term assets. Current assets basically means things that could be transitioning, changing within a 12-month period, like inventory. If you got stuff on the shelves in a store, they're gonna change. People are gonna buy. Then you're gonna buy new inventory. And accounts receivable, similarly, this is the money that your customers owe you. And, over 30 days, 60 days, depending on the accounts receivable terms, you'll get the money. So all that transaction, moving is taking place within a 12-month period. So that's why it's considered the current asset. Long-term asset is more like your building and your equipment, and plant and real estate, the building, stores, all this stuff that you own. These are not rental stores. These are something you own. But because they're more long-term, they're not going to change like the inventory does. So they consider it more long-term assets. Similarly, on the liability side, you'll have current debt, which would be like accounts payable, something that you owe your customers, typically going to pay them within less than 12 months. So that's short-term debt, short-term, and also some short-term loans that you may have. That means anything that you get from somebody, be a bank, and it's a short-term, which means that you owe them money back within 12 months, so consider it a short-term loan. Long-term would be, more the longer term. You got the long-term bonds, or you got the mortgages that are, go beyond 1 year, could be 5, 10, 15 years. Here you owe the money to the lender. In the interim, you'll be paying the interest that you will find, obviously, in the income statement, and you will see a line item called interest expense if you have a debt in the income statement when I talk about income statement after this balance sheet conversation. Last piece, equity, two pieces to it: shareholder investments, which is the money that are invested by the, shareholders initially, and once the company starts to make a profit, the company reinvests their business back in, retaining it, so they're retaining the earnings, and that also goes in the equity. So now let's look at the income statement. If you got assets, obviously the goal is to make profit. So you got sales, you got all your costs, and you end up with leftover as a profit. Now, before I talk about some of the key components in the income statement, obviously we want to understand, or at least be aware of it, that if our total costs are higher than sales, we'll have a net loss. Now, typically for a startup business or a new venture, you may find that you got to spend the money up front. Sales may take time to grow. So the first 1, 2, even 3 years, you can have a net loss. And hopefully after that, you're going to start to make a profit. For a mature company, or even companies that are in the growth mode, but they have been around for a while, that sales are going to be higher than total cost, and hence you will have a net profit. And then what happens to the net profit is that companies can put it back in the business, and that will become part of the equity. And depending on how much they make, sometimes they will give some of it to the shareholders, called a dividend. Typically, a startup company, a new company, like Apple was many, many years ago, or, Twitter or Facebook, in the early stages, for a few years, 10, 15 years, they may not give any dividends. They want to take all the money that they generate, profitability from within the company, and they want to put it back in the business as retained earnings so they can invest and grow their business. Now let's talk about some of the key components on the right side of the slide of what are in the income statement. Obviously, the first item is the sales. And then you have cost of goods sold, which is the cost it takes to produce a product. If it is a service industry like insurance company, banking, but you're not really producing a car or a computer, it may be called as a cost of revenue or cost of sales. So when you subtract the cost of goods sold or cost of revenue from sales, you're typically left with a margin, and most companies call this a gross margin. Now, you want that number to be positive because we still have more expenses to pay before even we get to the profitability. So then you have to pay your costs, like what's called SG&A, sales and general administration. That would include, your activity or your department like human resources. You got accounting department, you got a finance department, you got a legal cost, all the costs that are other than making a product could go in there. If the company also has got a lot of research and development going on, then they will separate the costs and call it research and development or R&D. So then they can see how much money they're spending in the R&D. Typically going to find this for a high-tech company, like in the aerospace or in the computer industry or etc. You'll find companies will show separately a line item called R&D. After you've accounted for all your expenses, these are the three big ones: cost of goods sold, SG&A, and R&D. There could be the small ones. But after you account for everything, you draw a line in the income statement and see how much earnings you have before you have to pay interest and taxes. It's called EBIT. So you may hear a lot about EBIT in your organization. That's what it is. Then if you have a debt on your balance sheet, then obviously you're paying interest on it. And then from there you are left with what is called earnings before taxes. And then you pay taxes and you got net income. So this is your net profit, and obviously as a company, you want to make profitability for all the time and effort you are spending and all the assets you got tied up. So as a management team, your goal is to manage your balance sheet, current, long-term, and obviously also the income statement. Okay. So let's talk about some of the categories of ratios now. The numbers and the formulas are all connected to the two statements I talked about, balance sheet, income statement. But let's talk about from a categorical point of view, from a, what are they? One is called the liquidity ratio. This is where you're looking more near term. And for example, if the company is in financial trouble or you're worried about it, you're going to focus on current ratio, liquid ratio, which is things like current ratios and so on. I'll show you some of the formulas for all of these categories. I will not spend a lot of time talking about the formulas because that will consume too much time. And from a non-financial management perspective, I think as long as you're aware of it, that's going to give you a pretty good feel. Obviously, in our MBA program, we spend a lot of time because we want to teach our business leaders to become very familiar with some of these things, so we get much deeper into it in our program. From an overall business performance, you're looking at it how effectively the assets are managed and also how effectively the profits are generated, in terms of, for all the assets that are tied up or all the sales you're selling, how much profit are you really making? I mean, you could be selling a lot, but if you're not making any profit, then obviously you're not effectively managing the company. And also the category called investor's perspective, where you're looking at some of the things like price to earning ratios and so on. And I'll share with you some of the numbers for some of these categories in terms of formulas, but later on I will show you TJ Maxx and Macy's so you can kind of see what the numbers look like for those two companies right now. Now, quickly going through those four categories, short-term liquidity ratios. They are there to measure company's ability to cover its short-term debt obligations in a timely manner. There are three key liquidity ratios. They call current ratio, the quick ratio, and the cash ratio. So what are we really looking for? We're looking to see if the current assets they have, remember current assets are stuff that can be things like inventory, accounts receivable, cash, short-term things. And compared to current liabilities, stuff that is more current, which means they are owed within 12 months, your accounts payable and your short-term debt. So you want to make sure that you have enough current assets to cover your current liability if you have to. So you typically want a number to be obviously higher than 1. Sometimes, depending on the business, the industry, they will also look at what's called the quick ratio or the asset ratio, where the consideration is that what if inventory that is on the balance sheet may not be worth a lot. For example, let's say you're looking at a retail store, departmental store, and they may have inventory like shelves of shoes and pocketbooks and clothing. So they are there as the inventory. And the value was there, whatever the company paid when they bought all this stuff. What if this inventory, the shoes, the clothing, are basically have no material value? They're sitting there for a couple of years and they're either out of fashion or out of season or whatever. In that case, one would wonder, is inventory really worth what is on the balance sheet? So in that case, somebody would look at and say, okay, what if I consider inventory to be worthless? So they take it out and they measure what is left over, which means they take the current assets, take out the inventory, compare that to current liability, and it's called a quick ratio. And in some instances, if they also feel like the accounts receivable may not be of any value because maybe the companies that owe the money may be going bankrupt, in that case, they will even take the accounts receivable out and use it as a cash. So typically, most times company will only use the current ratio, and then maybe sometimes get into the quick ratio. So, just be, so it really depends on the purpose of the analysis. But most times it's the current ratio that is used. The long-term one, we're looking at obviously longer term. It's a measure of company's ability to meet its long-term debt obligation based on its overall debt level and so on. Obviously you worry about failure, failure to meet its interest obligation. For example, even if the debt is long-term, which means the principal is not due for 10, 15, 20 years, but the interest expense, the interest, not the principal, but the interest is due every year, or depending upon the contract, could be every month or every quarter or at least once a year. So you want to make sure you got the interest, you're making enough money to pay your interest, because if you don't, you're going to be risked into bankruptcy. So the ratio that are typically used in that category are debt ratio, which is to look at the total liability, including short-term, long-term, and total assets, including short-term and long-term. You're looking at the times interest earned, which basically is that you're looking at the earnings before interest and taxes, the income statement. And as you may recall, when I went through the income statement key components, the next item right below the EBIT is interest expense, which means whatever earnings we have left over before we pay interest and taxes, we want to make sure we get enough left over to pay interest. Because if we don't, then obviously the bank will come after us and we could go bankrupt. Sometimes some company will look at it what's called the cash coverage ratio, which is EBIT plus depreciation divided by interest expense. So overall here, typically companies will use the debt ratio and the times interest earned, just to kind of get a feel for, how are they doing for a long-term solvency. On the asset management side, you're looking at managing your assets. So it could be inventory, which is the ratio of cost of goods sold divided by inventory. Sometimes that number is also portrayed in terms of day sales in inventory. It's the same kind of thing, except you're looking at it per day basis. You do the same thing for also looking at the receivable turnover and also looking at the receivable days. And you're also looking at the total, all the sales, and divide by all the assets, total assets, which means your current assets, long-term assets, and everything. See how you're doing. On the profitability side, you're looking to see, yeah, you're selling a lot, or you got a lot of assets, you got a lot of owner equity, but how efficiently are you performing? So this is where you're looking at how much net income is generated divided by sales. That's your profit margin. Sometimes people call that as return on sales, but it's typically called profit margin. The return on assets is the net income divided by total assets, and return on equity is net income divided by total owner's equity. A couple of these things I want to share with you for Macy's and TJ Maxx. You can see the comparison between the two companies. For investor perspective, there are some ratios, that would include earnings per share, which is the net income, divided by number of outstanding shares. You got price to earning ratios, which is the typical one you hear a lot. If the one you're going to hear a lot is going to be price to earning ratio, and the last one, which is market to book value. I will share with you the price to earning ratios for, again, TJ Maxx and Macy's, so you can see what the numbers look like for those two companies. So now let's talk about how do companies use ratios. They use it, to look trend. Are they getting better or worse? Are they achieving, if they set a target to be best in class, how are they targeting towards it? They also look at investors' reaction, because what happens is if the overall performance of the company with some of the ratios are not doing well, the investor's reaction, which is the price to earning multiple, is going to be not as good. And you'll see that when I compare TJ Maxx with Macy's in coming up slides. They also look to see how are they comparing with the benchmark. Are they industry average, or are they below average, or are they best in class? Or if they want to be best in class, they got to set some goals. And based on that, they will develop some short-term and long-term strategies, and the management team will start to lay out a game plan of how to improve, the areas where they need to improve, because really these are the gauges. This is, the financial ratios provide an analysis and opportunity of area that the company and the management team have to target. So the overall goal for the management team is to enhance the market value of the business. So, they would continue from a strategy perspective, do a SWOT analysis. The strength, the weakness, opportunity, and threat. The internal pieces of the SWOT is the strength and weakness, which means, what are the strengths, and what are the weaknesses. And externally, how is the external things factoring them, for example, in the, overall economy or overall change in demographics that they serve, technology, etc., and the competition. And based on that, they will develop a strategy. And the goal is the success of implementing the business strategy will be measured by financial performance. So the management team, obviously will cohesively work together, and then they are going to, depending on the areas where they are focusing on, they will look at the sub-teams. For example, if they want to grow sales, they can have the operations, engineering, and sales and marketing kind of work together to say, hey, what can we market, what can we design, how can we produce at the right price, and so on. If they're focusing on improving their costs, they could be looking at it collectively between engineering, operations, manufacturing, purchasing. Is how can they design products that are easier to make, less expensive to make, how they make it. If they're looking at, so that will help them improve their cost of goods sold. They're looking at the SG&A piece of it, looking at the research and development piece of it. So depending upon where it is, the business will then develop a strategy. But the goal is to enhance their future financial ratios. Now, they may have to go into some level of detail. For example, looking at the pricing strategy and how many they're going to make, because that all ends up in sales. Or how they're going to make it. The labor cost, productivity. They're looking at where they're going to purchase. What are they going to purchase? What they're going to make in-house. What they're going to buy. What they're going to make. How are they going to improve the quality to improve the cost. All that goes into cost of goods sold. All the administrative costs, how can be more effective? How can they have, better SG&A function? HR strategy with the talent optimization, improving the, training that can help overall improve the performance of the organization. Anything they can do better on sales and marketing, finance and accounting, any other SG&A function. All that cost goes in SG&A. If there's engineering function high enough, big enough, they'll separate that into R&D. All these pieces are basically, if you remember from the key components of the income statement, are the top four pieces. You got the sales that goes into EBIT, cost of goods sold in the EBIT, SG&A will go in the EBIT. So all these go into earnings before interest and taxes. So if you have sales, you're going to subtract from it cost of goods sold, SG&A, and subtract R&D. What's left over is EBIT. From there, you pay your interest expenses if you have a debt. You pay that leaves you with earnings before taxes. You pay taxes, you get net income. And if it's a publicly traded company, they may report the earnings as a percent of shares. So they will say earnings per share, which is net income divided by number of shares. And from there, obviously, you focus on cash flow on the balance sheet. So you got the cash flow, which comes from net income. More you are creating profitability, more cash you get, you can put it back in the business. So all that is coming from net income. Plus, you have inventory to manage. You have accounts receivable to manage, which are part of balance sheet. You have accounts payable, which is part of balance sheet. And if you're going to pay any dividends to you, that will require cash. And if you're going to invest in your business, maybe you're going to buy more inventory. Grow your factory, you're going to buy more equipment, all that goes in there. So all these help cash flow, which are then put back in the business. And then, the three pieces that are called working capital are inventory, accounts receivable, and accounts payable. Let's look at Macy's and TJ Maxx. They're both in retail industry, as we know. And the retail industry, we also know, is going through a major transition over the last 10 plus years due to the online retailers. With the technology of online buying, with the sophistication of the online buying, the transition has been more and more people buy online. So you got two companies, both have brick and mortar, and both are getting into online, but they typically were mostly brick and mortar 10 years ago. How they survived in an environment. On the right side, you see results of, example of store closing in 2018. Obviously, the big ones that are basically, kind of gone under, like Toys R Us, but even some of the other ones, as they've merged and combined, they're cutting back, on stores, and so the number of stores are really closing. And as you can see, from the malls, etc., that the brick and mortar stores are really kind of dropping, and and so it has been kind of difficult for the retail industry. So in the same environment, how are these two companies doing? Because overall, obviously, either of those companies, both of them, will, have gone through the strategic planning process, and depending on how well they're doing, would have resulted in, is their business sought after by the investors? So let's look at some of the ratios. I'll go through a few of them, just as an example, more than an application. I'll talk about each one of them in terms of formula, and then I'll show you for each one of them results for Macy's and TJ Maxx. So let's look at return on assets. Return on assets, as you may recall from my earlier slide, is an asset management category. The formula is net income divided by total assets, and the number will be in a percent, because you're going to divide two numbers, the results will be, so the ROA will be a percent number. The source of information, net income, comes from income statement, total asset comes from balance sheet. Here, obviously, it's a measure of effective use of the total assets. Income generated per dollar of assets involved. So let's look at TJX and Macy's. You want higher the better. In 2018 results, comparing TJX, which is on the left side, and the Macy's, which is on the right side, you can see the TJ Maxx is more than twice as better. They've done a much better job managing the assets in terms of creating profitability over their assets. Now, obviously, 1 year's worth of data doesn't really make it, worthwhile to say, oh, wow, this is a great company. When you're looking at the ratios, you have to look at a trend. You look at the last few years. Let's look at the last 5 years. The blue is TJ Maxx and red is Macy's. So you can see over the last 5 years, TJ Maxx, which is in blue, has done consistently around, close to 20%, 19 to 20%. Whereas Macy's has done overall, 7, 5, so around 5 to 7%. So obviously overall you can see that the TJ Maxx is generating higher percent of profitability as a percent of the total assets they have invested. And because we are normalizing it, we can make comparison between these two companies, even though one company is, slightly bigger. TJ Maxx is slightly bigger than ROA in terms of total sales. TJ Maxx is 40 billion and Macy's is 25 billion, but by ratio you can make these comparisons. So overall you can see that if I'm looking at return on assets, TJ Maxx is doing a much better job than Macy's. Let's look at return on equity. Again, asset management, net income divided by equity, and again it will be a percent. Net income comes from income statement, equity is from balance sheet, as we know, and obviously if you look at the TJ Maxx, again, almost twice as much. Long term, consistently better than Macy's. Next one, inventory turns. The reason I pick inventory turns is because if you look at a retail store, how effectively they manage their inventory, what they bring, how quickly does it stay there, etc. is important. Because inventory is inventory till it's sold and we create profitability and cash from it. So the formula really is cost of goods sold divided by inventory. And what you want this number is to higher the better. The source of information, obviously inventory comes from current assets in the balance sheet. Cost of goods sold comes from the income statement. And you want higher the better, because the low inventory turn means that high amount of inventory is in the process. If it's a retail store like Macy's and or TJ Maxx, if it is stuff sitting on the shelf, we got the money tied up, the capital tied up. So let's look at it. 2018, more than twice the better. TJ Maxx, across the board, over the last 5 years, consistently almost twice as good. Let's look at the total asset turnover, which includes everything. Inventory is an asset, but there are other assets, the buildings and all the other assets. If you look at the total asset, here we want to see is how much sales are they creating at the total asset. Obviously higher the better. Sales come from income statement, total asset is from balance sheet. And now we are basically looking at two. You can see that the total asset turnover for TJX is, again, in this case, more than twice as much. 5 years, consistently better than TJX is consistently better than Macy's. So all that means, as I mentioned before, is that, if a company has got a good strategy, they've kind of looked at these strengths and weaknesses, they've looked at externally. Remember, both these companies are feeling the same external pressure. But one company has done a better job, which means that if they've done a better job, their financial performance is better, which the ratios do indicate. They should be more sought after by investors. So let's look at a price to earning ratio, which is a measure of, how the investors feel about these two companies. Now, here's the data. I'm recording this lecture on November 17, 2019, which is a Sunday. So this data is from, obviously, stock market is closed on Saturday and Sunday. So this is from Friday, November 15th. So here, we look at the stock price is $59.82 and the stock price for Macy's is $16.85. So TJX is $59.82, Macy's $16.85. Now, we cannot make those two comparisons and draw any conclusion. Why? Because they're absolute numbers, they're not ratios. Similarly, market cap, which is $72.3 billion versus $5.2 billion. And market cap really is nothing more than stock price times number of shares. Obviously, intuitively you can tell the TJ Maxx is much better because it is, because of the market cap, but you still cannot make a real conclusion. What you want to look at is the price to earning ratios. Price to earning ratio is the price of stock divided by the net income per share. And here we are normalizing it. So if you have a price to earning ratio that is 24.2 versus 5.12, it is basically suggesting that the investors feel that the TJ Maxx ability to manage profitability and the growth is much better than Macy's. Okay. Now, if you look at it in terms of what happened to the stock performance over the last 5 years, obviously, like I said, you cannot compare absolute dollars, But what you can compare is how they have changed. So for example, if I look at the 5-year, and again I did this on Yahoo Finance, so you can use Yahoo Finance to compare any stocks, it's a good tool to do. And you can put in the period. Here I put in 5 years. I could have done it for 2 years, 1 year, etc. Which means that if 5 years ago, where I got the arrow on the left, if I would have invested $100 in Macy's and $100 in TJX today, or last Friday, November 15th, 2019, I would have made 88%, which means my $100 would have been up to $188. Macy's, on the other hand, that $100 would have been down because it is down by 88%, negative 88%, so my $100 would be down to $22. So, so you can see that companies, when they're managing, understanding their ratios, that helps them create strategies, and if they effectively execute the strategies, they are more sought after by the investors and also by the lenders. So, in summary, the key takeaways from this module: how do companies use the ratio? Obviously, they use it to look over the trend. Are they getting better? How do they compare with the best in class? Looking at the investors' reaction for example, price to earning multiples. They use it for developing long-term, short-term strategy. Based on that, looking at the SWOT analysis, developing the strategy, and if they can perform the financial performance, they are more sought after by the investors. And as the management team, they divide and conquer, and to see how can effectively manage their business, their organization, to be able to achieve above average performance. So I hope this was helpful. This is my last slide.